Good afternoon, traders. This is Christian from Tribeca Trade Group, and this is your end of day as well as end of week and end of month market recap for what is today. It is the 28th of February, and that's it. 2 months are in the books for 2025. A pretty wild way to finish the month of February. So, as always, I will go through some takeaways, what we learned about this year so far, what's performing well, what's not. What are some other conclusions that we can kind of draw away from the end of this week and the end of February? Risk disclaimer in front of you, everything that we're going through is for information purposes only, not giving out any advice or recommendations. Everything that we're going through is for information purposes only. Number one, I think just to watch how we ended for the day. This market moves very fast, and I think if you think that you're going to time every one of these moves, I think that it's very difficult. Unless you are a robot and you are not human, meaning like you need breaks during the day and so on and so forth. But just watching, for example, what happened at the end of the day yesterday, which was a pretty big spill lower at the end of the day yesterday, probably knocked a lot of people out of positions and probably frustrated people. That's what markets do sometimes. And as long as I've been doing this for, I've walked away from the computer screen many times extremely frustrated, or ending the week extremely frustrating and saying, geez, this is such a tough game. And sometimes you need a break. But that's how this market works. It is sometimes, and I've heard this from time and time, that the market is meant to frustrate as many people as possible, and it certainly does that from time to time, right? And you can never really get super complacent. I think for me, and I'm going to do my end of month video shortly for members, but I think succumbed to being a little bit complacency. We've seen this work probably so well over the last year, where every dip was bought to some extent. Now, some dips were a little bit more, were a bit deeper than others, but that has worked so well. And that's not always going to work. And that's why you have a trading plan, and you should be following the trading plan, rather than just on gut and emotion, right? Because there are no set rules. There's no one that says that every dip has to get bought. And I certainly got penalized for that a little bit towards the end of February. But also, it's important to look at many different factors. I've brought up a lot of these videos about weaker seasonality, and that played out damn well, in terms of, and sometimes it's not always the case. Sometimes that seasonality doesn't always line up perfectly. I was talking about this earlier in our Q&A session about, going back to 2023, the end of 2023, when we had a correction from about August to the end of October. Right. Everybody thought at that point that October was going to turn up, and it didn't. And October was another harsh month back in 2023. And then that kind of cleared everybody out. And what happened? A huge rally happened after that for months. But it doesn't always line up perfectly. So it's important, like always making adjustments, having a plan in each trade that you put on before you enter the trade. And also, what's sometimes very difficult is to follow the plan, right? And especially for things, and I remember like 3 or 4 names that happened to me this month, where one of my favorite trades is buying dips in names that have had strong earnings and are dipping back to the 20-day moving average. And that's a textbook setup. But sometimes the setups don't work, and sometimes they break through support, and you have to have a game plan for that, right? And in those situations, and in many situations in terms of trading, you cannot be, what's the term that I'm looking for? Well, just to say it simply, you can't be stubborn, right? You can't be stubborn and say, you're not going to do this and you're not going to follow your trading plan. And again, you have to go back to that first point, is that you have to have a trading plan to begin with. Many traders that I've seen over the years, they don't have a trading plan. And they don't have that plan in place before they get into a trade. And then they're panicking once they're in the trade, and you're already off on the wrong foot. Now, these things can all be fixed, and that's what that's why you speak to somebody who's in trading, whether you have a mentor or you're in a trading room with a bunch of people who have been trading for a while and have some best practices for you. But it is about learning and understanding, and everybody starts off that way, where they don't know exactly what they're doing, and they don't have a firm trading plan and a set trading plan. But um, back to the second point, there is sometimes it's not easy, and that's why this is not an easy game, because you have to follow that trading plan, and that means you take the emotion out of the equation. All right, so that said, let's talk a little bit about, I'm going to do an end of week review, and I'm going to do an end of month or year to date review, but here's where we are in SPY. So this is a start. And again, I was talking about how fast the market moved. Just take a look at the last hour or so. I mean, that's really where we kind of saved. Without this last hour of trading, things would not have looked very good. And it's the same thing. Look at what we did at the end of day yesterday, right? So it's almost like a reciprocal of the move that we saw, the end of the day move that we saw yesterday, and we kind of moved back. Now, does this mean like, oh my God, like we're going to go straight up? I can't, first of all, I don't have a crystal ball, and I think you have to kind of take one day at a time and to understand that we're back in the range that we've been in, and that may very well be the case for a while. What I would like to see is, number one, so this was the first step, was to see us close back inside the value area for the month of February. For February, notice at the bottom of value here for the SPY is going to be just about the same thing as it was for February. So most likely we're going to start inside the month for March, which I view as a good thing. Right? I don't want to see us begin to break down and start to have to visit those lower levels. But ultimately, I would like to see us get back above all these moving averages too. That just shows me that the market is more healthy and it's a stronger market. Below the 50-day moving average is not, which is this line in here, is not a position of weakness. Sorry, is not a position of strength. I'm going to make a few mistakes in this video, I'm sure, because it's been a long week, and I've done a video every day this week. I don't think a lot of people do that. Every day this week has not gone perfectly for me, so I suck it up every day, and I try to do a video unless I've got some other engagement that's going on. But I don't skip them just because I'm in a bad mood. I give you these videos, and I hope they're helpful to some extent. Let's keep going here. So the one other thing that I noticed, sometimes you'll pick up on these subtle things, but there's also a nice divergence here, right? As the S&P made a new low for this week, notice that the RSI did not, right? So that sometimes that works, sometimes it doesn't, but sometimes it's a nice little clue that going down here, there's not a lot of momentum in that last push down, and sure enough, buyers came in and supported this. I also thought the beginning of the day was important too. If we just go back, because again, these are little clues that you pick up. What did we do just about every day this week? I don't know if it was every day, but it felt like it was every day. But in the first hour of every trading session, we whooshed lower, right? And it basically wasn't until like after 10:30 where the market began to try to find a footing. Today was different. This is just the first 5-minute bar. We started to go lower, and buyers actually came in and supported this, right? And what I mean when I say buyers, right? We ultimately need institutional buyers to come in, not retail. Retail's not big enough, right? The institutions, the big guys and girls need to come in and support this market. And it kind of felt like today that took place. Now, today was also end of month. So, it's difficult to make a judgment on the end of the month because there's a lot of mechanical things that are going on. But it did feel like there was some buy the dip mentality, and maybe the selling pressure just got exhausted. Sometimes that also happens within a dip, is that finally, like, there's the sellers who've been doing a lot of selling have done what they've needed to do, and that's it. And so for them to kind of push around the market this week, whoever wanted it, could be multiple hedge funds, could be other institutions, wanted to basically get out of this market for the most part this week. And that happens with the way that things go. The Qs, I'm also going to just bring up the 1-hour chart because we did take out, this was lingering here with the reminder that we had the PCE data this morning. And I was wondering if this VPOC was going to, what was going to happen here because price was so close to this. And here you go, there's the VPOC being taken out. And we came back and tested this around 2 o'clock today, and we held it. So again, this is not in a position of strength, I would say, here for the Qs, right? Because this did not close back inside the value area. And similar to the S&P, the March value, bottom of value area is the same, is very similar to what it is March versus February. And this did not close below. This is also still below the 5-day moving average. So we know that the Qs have been showing some relative weakness here. That's where we, in relation to the S&P, that's where we're at. Is that this is a more of a problem area than it used to be in years past, where the Qs have outperformed. What about IWM? Did the picture in IWM change today? Nope. Even though we're up 1.1%, this is still below the 5-period moving average, still below the 200-day moving average, which means that in my opinion of or my definition of a downtrend is that if you're below the 200-day moving average, you're no longer in an uptrend. So to me, this is in a downtrend below the 200-day moving average, and it's also in its value area for the year, all right, which is here. So 218.45, and this should trigger the bearish 80% rule if IWM cannot get back above 218.45. Any of these concepts are unfamiliar to you, you could always ask me questions. We're also going to be doing a webinar next week that is going to be for Tribeca Trade Group members. But we do an extensive webinar where we talk about the value areas, we talk about the new March value areas, just as I did for the Qs and S&P. We'll do that for more and more sectors and individual names, and go through a heck of a lot of charts. Could this be a cup and handle pattern? It could. I mean, this is a cup. I try to stay objective to any of these types of things. Here's your cup. Here would have been your handle, but this is going to have to regain, and at least at the very start, get back above 218.45. All right. Let's talk a little bit about the equally weighted S&P, right, which I think fared better this week, right? And it's just above the value. This doesn't have as much bumper room as S&P and the Qs to the top of the value area, but looks like that. So this is going to be a very tight value area. This was a very range bound chart. It certainly did not see the same type of downside volatility as the Q saw and growth stocks over the last couple of weeks. The average stock in the S&P, which this is what this ETF is. It's the S&P, but instead of market cap weighted, it's equally weighted, right? And it just kind of shows you too, when you look at what the big names have been doing in the S&P and in the Qs, they've been underperforming, right? And that can really tilt, right, the performance and the chart pattern of what the market cap weighted indices look like. Here's QQEW. And again, this is also just amazing how fast this happened. This had just hit about a week and a half ago, or maybe it was 2 weeks ago. It hit a 52-week high. Right. So again, that's not easy to deal with. When something is breaking out to new highs, you usually you want to be in those groups that are showing, at least I do anyway, that are showing relative strength. Let's also just bring up the Dow, which outperformed this week. It was up 1% this week. Again, not anything to write home about. But it is above the 50-day moving average, where the S&P and the Qs are not. All right, so there's the difference there. Slightly a little bit stronger, but this stat might blow your mind a little bit. Here's value stocks, right? And value stocks, they succumbed to that end of day pressure yesterday, but they had a nice bounce back today. And I would keep an eye on this chart next week. Watch 170. Well, this is going to be the new value area, but I would still watch this 178.23. Notice how tight this value area is. I think there's going to be a big move of value stocks next month. All right. That's a small prediction for you. Why am I making that prediction? Because look at how coiled this is right now. Right. And how tight this value area is for March, which is this yellow box right here. So that usually means a big move is coming. I can't tell you what direction it is, but right now it's leaning higher and it's above all the short-term moving averages. So here's the stat that may blow your mind. Year to date, This value ETF, which is mainly large cap value, is up 5.2% year to date versus growth is down 1.2% year to date and has really given back gains because I think over the last 2 weeks, even including today's rally, this is down 5% over the last 2 weeks, which is a decent move down, and it looks pretty sloppy here below the 50-day moving average. All right, so that's the main stuff. And again, this value, I know that a lot of folks that I follow on Twitter and really good follows on Twitter, some of them, some um, completely ignore value stocks, and they're only about small cap growth names or high growth names. My philosophy, like, so that's nice, and it's nice to have those folks that specialize in those. But the market isn't just about growth stocks, and I hate to break it to you, right? And that's why we've had these conversations, we've had these arguments too, or debates about breadth. I like when it's not just high growth technology or AI stocks that are pulling pulling the cart, right? I don't think that that's a very healthy market just to say one group of stocks, high growth stocks are the only ones that are doing well. To me, like, and again, it's not to say that you can't make money with that. It's just not the market structure that I prefer. I personally like when you've got a variety of stocks. I think it's very good for diversification because I like to hold stocks long term, right? And follow basically the trend. But I'm going to give you a couple of names, and I'm going to start with a growth name, right? Look at how well this Bros acted this week, right? Big gap up, right? Retraced about half the move, right? It didn't. There's so many stocks that retrace the whole move, which is okay too, because for instance, a Palantir, which filled that whole earnings gap, but that's just too volatile of a move. That's not, again, to me, that's not realistic to have a stock go from $80 to 120 after it already ran from $20 to 75. That's, that's to me not realistic for a name to just keep going like this, especially how expensive Palantir is. Now, so I mentioned Bros, right? Showing a better, some strength here. But let's look at some other names outside of tech, right? How about healthcare? Well, uh, sorry. Here's AbbVie breaking out. There's nothing wrong with a healthcare pharma stock breaking out to new highs. What about MasterCard? Right? MasterCard breaking out to new highs. Now, I get it. It's a $570 stock. It's not as easy to trade as a Palantir because of the price of the stock, but I think pretty healthy. What about a low, a cheaper industrial name? Here's 3M out to new highs. So I think it makes sense. And again, most of these names that I'm talking about have had the thread that's common here is that they've had good earnings. Right. And usually the ones that have good earnings, and now we're going through we're going through a little bit of a repricing. I'm going to show you one other thing too that might make a little bit of sense to you. All right, so I mentioned those stocks, and I keep a list of these stocks that have strong earnings because I believe that they are going to be the potential leaders for the next quarter. Here's a slide that I think makes a lot of sense and kind of puts things in perspective. That's a word that I've been talking a lot about this week. Here's the S&P 5. This was a slide from Bloomberg that came out last weekend. I've talked about it a few different times in the trading room this week. The S&P 500 is trading at a higher valuation multiple than European, Chinese, Mexico indices. Now, this has been the issue for a while, right? This is nothing new, and we know that China has been very cheap for a while. That's not a reason, in my opinion, to go out and buy stocks. But I think we just got to a point where the market got really expensive and a lot of stocks got really expensive. And sorry, Palantir, I'm picking on you. And I'm picking on a lot of other stocks too, that they just got too expensive. And what happens, right? Once stocks get too expensive, institutions rotate out of them and they go into some other names. Now, that's kind of the explanation. If you go back just to where we were a couple weeks ago, you had the QQEW breaking out to new highs. You had the IBD 50 index breaking out to new highs, but very expensive, right? So, Here's the IBD 50 ETF, which just got absolutely annihilated the last couple of weeks because a lot of these growth stocks are just too expensive and they need to be repriced a little bit. It's not to say that they're not good companies. They just ran up too much. And that to me is okay in terms of like to see profit taking. And sometimes profit taking and rotation can be quite painful. That's what this was over the last two weeks. And I get it. The other thing that I come back to is that QQEW, FFTY, communications and cyber stocks, those were your leaders, right? So it's a little bit painful to see that rotation out of, but this happens from time to time in the market. What else was it? So I was going to also talk about the performance for the week, which I think I mostly talked about. SPY was down 1%. The diamonds outperformed. Qs underperformed with the IWM, and the Qs underperformed. Emerging markets saw some profit taking. Like if you go down here, you'll see KWeb was down 7.4% this week. Keep in mind the last 2 weeks that the KWeb was up like about 8%. So giving back some of those gains. The semiconductors down 7% for the week. So again, we're not out of the woods in terms of all these areas, but I think that you might see some new leadership, and maybe that's in some value stocks. And while financials I think are still expensive, I think those might hold up a little bit better. Somebody asked me on Twitter. They said, "Hey, because I pointed out how well insurance stocks have been behaving. Why do you think that's the case?" Well, because it's a little bit more risk off, and the market wants cheaper stocks right now, right? Especially with a lot of this, we're in a headline market right now. This happens with any president the first couple months that the market tries to get used to a new president. And it's usually, in my experience, it's a bit bumpy. Like the first 3 months, 6 months with a new president, doesn't matter Republican or Democrat. The market needs to understand their behaviors and what they're up to, and they're a little bit about their personality. So again, let's try not to be political here. It happens, I think, with every president. Also, what was a positive this week that's to me stood out like a sore thumb was European financials. I mean, is this really a situation where the market is that bad when you've got European financials breaking out to new highs? I would argue that no, and I would argue that the market is going to dip. And again, I'm repeating myself from earlier in the week, but from time to time, you're going to get corrections. Every year is going to have some sort of, usually 2 to 3 corrections the market's going to have. So you have to get mentally prepared that the market isn't going to go up all the time and that there's going to be corrections. And believe it or not, that's where your big buying opportunities are. If you've got a longer term time horizon than 1 or 2 days. So these are the things that come back to me is that, hey, corrections are usually very good for putting money to work, or dips, because I don't want to say that this was a market correction because the S&P is not that far from the highs. Certainly, depending on what groups you're looking at, you could argue that many groups have had corrections at this point, down more than 10%. We just talked about a couple of them. I'm just gonna last thing I will give you the let's see if I have this. I think this is it. Year to date, or for February, I should say, what areas did best? The Chinese internet groups, even though they were down 7% this week, still up 8.5%. Consumer staples really outperformed consumer discretionary. Right, we've talked a lot about that over the last week or 2 weeks. Insurance stocks right up there, up 4% for the month. Energy did well too. Telecom stocks. So again, a lot more value type groups. Doesn't matter. Value growth, clean energy seems to always go down, down 10%. Uranium stocks went, that was another group, right? And by the way, like again, I'm not trying to beat a dead horse here, but Oklo, like some of these companies, they don't make any money, right? And they've just gone up on the possibility of them, getting contracts and possibly making money. That's not sustainable. When you don't have real earnings or even real revenue, these moves, like you can't get married to these names that, and it's the same thing with the quantum stocks too, which, hey, they're fun. Oklo is fun to trade. There's no doubt about it. But you cannot be in these names for that long with the understanding that they don't make any money, right? Same thing with the quantum stocks too, right? Many of these names, they don't make any money. They're not even close to making any money, right? So for them to go up to 24 bucks, fun, okay? But that's not sustainable either, right? So I get it. Like these were some themes that were really interesting, but if a name doesn't make any money, right, you kind of have to, have that in the back of your mind that this is momentum. It's fun to trade, and that's all it is. All right, guys. That is it for the end of week recap, end of month recap as well. I'm looking forward to March. Now, it doesn't mean that March is going to be, much easier. There is a stat by Jeffrey Hirsch, Almanac Trader, talking about the performance. I think for the first week or so, you could look him up on Twitter and you can get that information. But I'm looking forward to, after what we've seen so far in the market, and also just getting that, washing that complacency. Every time we have one of these market dips, I don't know about you, but I get more aligned with what I'm needing to do, and I become a better trader for it. So anyway, have a great weekend, guys, and I'll see you on Monday.